Hello class, welcome to lesson number 2 of our topic number 5. In this lesson, I will be considering the raising of capital. The raising of capital by companies. Now, you will notice that companies will have two options in the raising of their capital, that they can either raise capital from the members of the public, where they are looking at external sources of capital, particularly share capital. Then they also have an internal options where they can be raising additional capital from within their existing membership. So I want to list a number of ways by which companies will be raising capital, which we shall subsequently be discussing. So we have methods such as a direct invitation available to the company, offer for sale is also an available option to the company. The company could also do placing. We could also have a bonus issue of shares. It is also possible that we have a rights issue. It is also possible that we have a rights issue. We can also look at the possibilities of a conversion issue. It is also possible that we can have a scrip issue. So these are some of the ways that are available for this company to raising share capital. We shall see some of them are external sources, while others will be internal sources. So where this capital is being raised from an external source, we shall be looking at this process known as the flotation process or floating of shares, which is the legal process by which a company avails its securities to the public, You notice, the moment we talk about availing securities to the public, then we are particularly referring to only public companies. Private companies may not have this option available to them. They will not be approaching the publics to subscribe to their securities. So some of these methods involve a public invitation in a flotation process. Others will not be involving a flotation process. So we want to look at them one by one and see which of these methods will be involving the flotation process and which ones will not be involving the flotation process. So beginning with the first of those methods, which is the direct invitation, In a direct invitation, the company intending to raise capital prepares a prospectus. They will be preparing a prospectus, which is an information tool, a document by which the company will be giving information to possible subscribers, to the members of the public about itself. So in this document, the company will tell the members of the public about how long they have been in business, who are the managers of this company, what kind of business they are involved in, how much capital they wish to raise, what number of shares are they issuing, value per share, rights of these shares, a lot of information that is supposed to give the potential subscribers enough information on which they are to base their decision on whether they are going to buy these shares or not. So once the company has prepared prospectuses inviting the public to subscribe for these shares, there is a risk that the members of the public may not respond to this prospectus issue overwhelmingly. For instance, if through a direct invitation where we are issuing a prospectus inviting members of the public to buy securities, let's imagine we want to raise 100 million worth of share capital by way of a prospectus issue. There is a risk that the subscriptions we get from the members of the public could only maybe be at 70 million. Sometimes it could be worse. We may be falling at 70. So that we have a serious deficit with respect to the target of 100 million. Then it therefore becomes necessary that this company, doing a direct invitation to raise share capital, may now be required to do what we call underwriting the issue. In underwriting the issue, the company gets into contact with an underwriter. Underwriters will usually be investment banks or insurance companies, which will be giving a commitment to the company issuing shares that for some commission, we refer to as the underwriting commission, that they will take up a percentage or the whole of the capital or the whole number of shares that will not be taken up by the public. So possibly they are saying, we will take up everything else that is not taken up in the issue. So if this company invites the members of the public to subscribe to a share capital worth 100 million and the public only take up 70, the underwriting arrangement could be such that the underwriter is to take up the balance of 30 million that has not been taken up. So the underwriting gives the issuing company some confidence that at the end of the day, once we invite the public, even if they do not subscribe to the entire amount of share capital that we wish to raise, then the underwriter can come in and provide the whole of the balance or part of the balance as will be agreed in the underwriting contract between the issuing company and the underwriter. So something that should come out very clearly in the direct invitation, this company that wishes to raise capital by way of a direct invitation will have to go into the details of preparing and issuing a prospectus. Now, in the prospectus issue, there is a lot of publicity that this company has to create, that they have to do a lot of advertisements through TV, through radio, through newspapers, just to sensitize the public. Let the public be aware that we are in the process of raising our capital, that we're in the process of issuing additional shares. Let the public know that there are shares that are available for them to subscribe. And then, of course, with the risk that we run, that all these shares may not be taken up, the issuing company may also have to arrange for underwriting, where they get an underwriter to commit to them that any portion or part of any portion of this share capital that may not be taken up by the public, then the underwriter will provide consideration for such amounts. So that is the direct invitation. We have another option that is available to these companies, which is the offer for sale. An offer for sale. In the offer for sale, the company that wishes to raise capital involves a second company that we shall refer to as the issuing house. So what happens is that the company raising capital will allot. They will allot all the shares. They will allot all the shares to the issuing house. They will allot all shares to the issuing house, so that this issuing house now goes on to take up what the company raising capital would have done. So the issuing house takes up responsibilities such as preparation of the prospectus. They will also be arranging any underwriting if necessary to underwrite the issue. So in a way, in the offer for sale, the company wishing to raise capital gets another company to do the work for them. So this second company is the issuing house. It is the second company that now takes up the responsibility of preparing prospectuses on behalf of the company that wishes to raise capital. If underwriting is necessary, it is the second company that also takes up the responsibility of ensuring that the issue is underwritten by an underwriter. So that when we now have applications made for shares of this company, then the issuing house will be renouncing their allotment in favor of any applicants who apply for these shares. So the main difference we notice between these two processes, in the direct invitation, the company raising capital goes directly to the public, prepares the prospectuses by themselves, and if any underwriting is necessary, they also underwrite by themselves. In the offer for sale, they get assistance. They transfer the responsibility of the issue to a second company known as the issuing house. How so? That they are allotting all these shares to the issuing house, which in turn now issues them to the public. By preparing a prospectus on behalf of them, they also arrange underwriting if necessary on behalf of them. And should we be receiving any applications for the shares of this company, which had been previously allotted to the issuing house, the issuing house renounces their allotment in favor of the applicant that they receive in respect of these shares. Then we have the third option that we may have, which is the placing option. In the placing option, we still have our company that wishes to raise capital by way of issuing shares. But something different you will notice this time round, this company will not be going to the public directly, but still they will be using an intermediary. The issuing house will still be involved. So in the placing option, the company allots the shares, to an issuing house which then offers them to specific persons, or institutions or organizations. Now, in this case, because we are not inviting the publics directly, then we are saved from the inconveniences and all the costs of doing a prospectus. Then we shall also not be faced with the risks of doing an underwriting. That what the company that wishes to raise capital is doing is, they are allotting all these shares to an issuing house, and then they give them the responsibility of having these shares offered to possible or willing investors. So the issuing company approaches individuals who maybe they have a relationship with, who maybe they are sure that if they pitch to them the idea of buying the shares of this company, then they will. Because of the fact that they are not going to the publics directly, then in this placing process, we are excused from preparing prospectuses. We only prepare prospectuses when the issue is a public issue, when the issue is targeting the public or a section of the public. But in this case, because we are attending to individual institutions, individual organizations, individual persons, then we are excused from the preparation of prospectuses. Now, these two methods will be the preserve of public companies because the public is involved. As you will already be aware of, private companies by their articles restrict the invitation, actually they prohibit the invitation of the public to subscribe to their securities. So they cannot be doing a direct invitation, they cannot be doing an offer for sale. But a placing option is available for them because the publics are not being invited directly. Now, we have these other options available. If you look at these three options, the companies were targeting outside sources to increase their share capital. In the remaining of the sources, then the company will be targeting internal sources to increase its share capital. For instance, a bonus issue. A bonus issue. What will be a bonus issue? This is the issue. This is the issue of additional shares. The issue of additional shares to existing members in proportion to their current holding, for no direct consideration. We are issuing additional shares to existing members in a proportion. We are getting as much as we have, depending on the number we have. So we are issuing these shares in proportion to their existing shareholding. And most importantly, what makes it a bonus is that they are not giving us any consideration directly. They are not giving us any consideration directly. So the question should be, how do we finance a bonus? How do we finance a bonus? Now that we are not getting anything directly from the receiving members, where do we get the money to finance a bonus? Bonuses are financed. Bonuses are financed by reserves. Bonuses are financed by reserves, e.g. retained earnings, e.g. retained earnings. A reserve such as retained earnings could be a possible reserve from which we could be financing a bonus issue. It is because of this reason that a bonus issue is also referred to as a capitalization issue. Bonus issues are also known as a capitalization issue because they present to us an option through which we can capitalize our reserves. For instance, when we plow back our retained earnings and make them part of our capital by issuing or by executing a bonus issue, then we capitalize. The result is that we have capitalized that reserve. Now, for a bonus to be effected by a company, there are some conditions. There are some conditions that are necessary. Conditions for a bonus issue. Conditions for a bonus issue. That there will be some conditions that the issuing company must meet before they proceed on to effect a bonus issue. One of those conditions is that it must be allowed by the articles. We must get the permission of the articles. So the articles must allow. So if the articles of our company do not anticipate a bonus issue being executed by the company, then the bonus cannot be issued. Once we have the articles of the company allowing, then the bonus must be recommended. The bonus must be recommended by the board. The bonus must be recommended by the board. So it comes out of a recommendation of the board that we can increase our share capital by capitalizing a reserve such as the retained earnings. Then with the recommendations, it must be approved. It must be approved by members. It must be approved by members by a vote of the members. So we're imagining a meeting of members where the members are presented with a motion to capitalize reserves such as the retained earnings on the recommendation on the board so that they approve such transaction. Beyond the approval of the members, we're also saying that the company must have sufficient capital. The company must have sufficient capital so that the capitalization should not be a way of creating enough capital for us to work with. This should be seen as extra always. Not that we were already suffering capital crisis or one of the sources of capital we are looking into is a capitalization issue. No. It should always be we are capitalizing to go over and above our present requirements. That we are already not lacking. So when we are in capital problems or capital deficits, then a capitalization issue will not be effected or cannot be effected. The other conditions that we must also be meeting is that it must be within the ratio, allowed by the articles. It must be within the ratio allowed by the articles. So the articles will also go on to tell us how many shares per existing share can be issued as a bonus. So can we get a bonus of 1 share for every 10 existing shares we have, Do we get a bonus of 1 for every 20 shares we have? So the bonus must always again be paid within that ratio that the articles are allowing. Then we are saying that if this company effects the bonus issue, then notice must be given. Notice must be given to the registrar. Notice must be given to the registrar. If it so happens that this is a public listed company, then notice has also to be given, or we also have to seek the approval of the markets regulator. In our specific case, we are talking about the Capital Markets Authority. That if the company, in this case, executing a bonus issue, is a public company quoted in the Nairobi Stock Exchange, for them to effect a bonus issue, they will need the approval of the Capital Markets Authority, which is the regulator of the publicly traded companies. So that is the bonus issue and the conditions that we must observe to effect a bonus. The other option we have is the rights issue. In a rights issue, the company is issuing additional shares. The company is issuing additional shares, to existing members, in proportion to their current holding, at preferential terms, in proportion to their current holding at preferential terms. So one of the differences you would see between a rights issue and a bonus issue is that in the bonus issue, we were not paying anything, so to speak. We were not giving any consideration for the shares we were receiving in respect of our current shareholding. In a rights issue, we are giving something, but this thing that we are giving, the consideration that we are giving, is at preferential terms. Usually, for companies that are traded, listed companies, the rights issue will be executed at a price lower than the market value. So that if the company in question is a listed company and the current market price at the stock exchange is 50, maybe we could be doing a bonus issue at 45. The idea is we are giving an opportunity to existing members to take up more shares at a lower price. That if these members were to buy these additional shares in the market, they would be paying the 50 shillings. We are now giving them an option to take up more at a lower price, say 45, say 46. Anything lower than the market price would be considered to be a preferential term, would be considered to be a better term offered to these members. So rights issue will have the effect of, again, increasing the company's share capital, but being more so a special opportunity given to existing members to increase their shareholding in the company. That this option is given to the members of the company, that they can take up additional shares at preferential terms by paying less than they would be paying in the market. Now, when the rights issues are being effected by a company, the members will be given 3 options that they can exercise. That members will have 3 options in respect to the rights. That the first option is that they can exercise the rights. In exercising the rights is that they can actually buy those additional shares that the company is offering them in respect to their current shareholding at that preferential rate that they are being given. The second option they have is where they transfer the rights, or simply selling these rights. Now that I have an opportunity to buy these shares at a lower lower price. It could be the case that I have no money to buy, or I am not interested in taking up any additional shares, but they can transfer that right to another member or a non-member to buy such shares that are being offered as part of the rights issue. Then the third option they have is to ignore the rights. To ignore the rights. That is the third option. It appears to be the worst of the options that the members can exercise, where the members are simply doing nothing about the rights. That they are not going to buy additional shares that are being offered at preferential terms. They are also not going to transfer their rights to anybody. So the rights simply expire, and those members forego the option to take up these additional shares at the preferential terms that had been given by the company. So if this is a publicly traded company, that is, it is listed in the stock exchange, then to execute a rights issue, this company will require the approval of the Capital Markets Authority, which is the regulator of publicly traded companies. So that's the rights issue. The other option we have is doing a conversion issue. The conversion issue results out of securities, usually of debt nature, that have the right to be converted into equity. That we have issued debt securities maybe in the form of debentures, and we create rights on these instruments, on these securities, that they are convertible at the option of the holder into equity. In such cases, then we are talking about the converting of debt securities, into equity. Converting of debt securities into equity. So the holders of these debt securities, once they exercise this option that debt has been converted into equity, then the result is that we have an option of having raised our share capital, that our share capital is increased as a result of this new equity created as a result of the converted debt. The point is, for this conversion issue to be effected, the articles must be allowing for such conversion, and the particular debt instrument being converted must have the rights of conversion into equity. Then finally, we have the scrip issue. In a scrip issue, this is an option. This is an option to members. This is an option to members to receive dividend by way of additional shares in the company. So at the year end, once we have declared our dividends that we shall be paying this much per share held, the company can give options to its members via its articles that in our company, we have afforded members the option of taking up dividend by way of additional shares. So for mathematical representation, if we have shares valued at shillings 5, and the dividend payable to an individual member for mathematics purposes being 5,000, then we can be giving an option to this shareholder. Instead of receiving your 5,000 Kenya shillings in the form of cash dividend, we are giving you the option of taking up additional shares. So where the value of a share is now currently 5, then this 5,000 is affording this shareholder some additional 1,000 shares. So in this case, this member is being given this option that instead of taking up in cash form the 5,000 dividend, you have the option of taking up 1,000 additional shares in this company. This is a scrip issue. The effect is that we have given ourselves an option of raising share capital as a company. So, dear class, this is the issues that we wanted to consider in this lesson regarding to raising of capital. We have looked at the various options available to the company, particularly the direct invitation, where the company was targeting the public, issuing a prospectus as well as underwriting if necessary. We have looked at the offer for sale, where the company was transferring the responsibility of the issue to a second company. We have also looked at the placing option, where again the company transfers the responsibility to a second company, but this company does not go to the public directly. It goes to specific persons or specific investors and offers those shares to them. Then we have seen these other methods where we are looking inwards. We are looking at internal sources, where the company can possibly do a bonus issue by offering members additional shares for no direct consideration. We have also seen a rights issue being a possibility, where we are offering more shares or additional shares to members, but this time round at a preferential rate. Then the possibilities of a conversion issue, where the company is offering holders of debt securities the right to convert them into debt. The net effect being that our share capital, equity capital, is increasing. And finally, a scrip issue to those members who are receiving dividends, that we are giving them an option to take up additional shares instead of cash dividend. The result being, again, increasing the company's share capital. So class, that brings us to the end of our lesson 2 on matters raising capital. Thank you.